Our next panel is all about institutional investing. Our moderator probably knows the institutional investor landscape of this industry better than just about anybody else. He spent 4 years as the head of institutional investing at Lending Club. He is now the head of institutional capital markets at Lending Home. So could you please join me in welcoming John Palin and the institutional investor panel.
Good afternoon. Wait for everybody to get seated.
Lisa and I walking, just sat right in the middle.
Sit down here. So thanks for staying with us so late in the day. I'm Jonathan Palin, currently head of institutional capital markets at Lending Home. Previous to that, I spent the past 4 years spearheading Lending Club's institutional sales efforts. Now, Lending Home is an online originator for the asset-based short-term residential housing market. There's been a lot of interest in the disruptive lending or peer-to-peer space from both retail and institutional investors. We're going to focus on the institutional side today. We'll take some questions that I fielded a lot on the sales side, as well as some questions of my own that I think people want to know or figure out. Obviously, Lending Club and Prosper have both seen a tremendous amount of success, as well as some of the bigger up-and-coming platforms. Today, I really want to dig into kind of what are the niche plays, what verticals, what verticals are next. But before we dive into that, let's turn to our panel here, and everybody can quickly introduce themselves.
Hi, my name is Nicole Rothschild. I'm the CEO of Petra Partners, an investment manager based in New York City. In November of 2013, we launched Petra Credit Fund 1, which focuses on the online, or now called marketplace, lending space.
Scott Riles, I'm the managing member of Echelon. We started in September of last year. We managed $75 million today in 2 formats, a leveraged loan spread fund and then a diversified fund off of multiple platforms.
Don Davis with Prime Meridian Capital Management. We're an affiliate of Novus Investments, an alternative investment management firm. We launched in May 1st of 2012, peer-to-peer lending fund focused primarily on Prosper loans.
I'm Eric Thurber, founder and managing director at Three Bridge Wealth Advisors. We're an independent investor advisory firm located in Silicon Valley. We manage capital for an exclusive group of entrepreneurs and venture capitalists that have had a successful exit. It's an area that we've been invested in now 3 or 4 years, and talk through how we've done that.
Hi, my name is Ashish Jain. I'm with Blue Elephant Capital Management. We manage a levered consumer fund. We invest in Prosper and funding circle loans at the time.
Thanks. So I'll start off with, given the success in unsecured consumer credit, what verticals next? Who are the best players in that space, and what are the biggest risks to that space? Anybody?
I think, as we've seen today, that there are a lot of, many new players out there. And for us as a fund, we look for where there's the borrower's needs. So we look and we see now that Lending Club is expanding into business loans. So we're following that. We're following now, we've had some nice discussions with some of the newer realty plays like Lending Home and Realty Mogul. And I just think it's brand new for a lot of these platforms, and it's just wide open. So we don't have one specific platform that we're tied to.
Eric, where are you seeing a lot of the ecosystem kind of gravitate towards the third-party funds? Where are they starting to
well, I would say that I see a difference between what I saw in the peer-to-peer space early on versus what we're seeing in some of the other spaces so far. I mean, it seemed very clear and obvious that Lending Club and then secondly, Prosper were going to be at least the big market share winners here. And I think when we think about our risks as investors, again, our job is to preserve capital for people that have already made it. And when we think about that, I think the platform and how we evaluate the risk on the platforms is fairly significant. We spent a lot of time before we got comfortable with Lending Club. And so I think there's a lot of fragmentation in these other markets. So as an institutional investor, we're going to be a little slow until we feel that there's some less platform risk amongst these different providers, and I think there'll be consolidation there once we feel like there's some opportunity. But if you think about the opportunity, I think that if you look at real estate, you look at education, obviously the things we've talked about today. But I mean, there's a lot of, and we're first inning in a lot of this stuff. And as an institutional investor for clients, I feel like we need to spend a little more time to feel like how this is going to shake out before we move forward with some of these.
That will kind of go towards my next question. At Lending Club, they spent the first year deploying their own capital, so they had payment history. And I spent the first 2 years, hitting the pavement trying to get investors to invest on the platform, and still we didn't have enough track record 4 years down the road. How are you guys getting comfortable today with new origination platforms who essentially have no track record as of yet?
We're a quant shop, and so we look at credit models, and we, if you will, underwrite the underwriter first and underwrite the loan second. So particularly in the consumer space, there's lots of data, and if you can, a good credit department is going to build a model. You can back test that against third-party data and get a pretty good idea whether that model is going to work or not. That doesn't mean that you're not taking more risk there, and what we also look for in younger originators is over a short period of time that they keep having increasing versions of their rate at which they're revising the model is increasing, and we're seeing better accuracy. But if you can backtest fairly comprehensively, then there's a lot less risk with a first-time originator, particularly if you're in a category that's not novel. But just going back to the last question, one area that we see a huge amount of activity is, and related to this question, is we think there's a gigantic opportunity in supply chains. If you look at the major industrial activities, whether it's building cars, building aircraft, building computers, almost all of those activities are involved with software-enabled supply chains up and down the system. And all of those people generate invoices, and all those invoices are seeking to be paid. And ultimately, at the upper end of the ultimate customer, that's the fundamental credit, is an investment-grade borrower. So that's a case where you don't need to do a lot of credit work if General Motors is ultimately going to pay your bill.
And who are some of the players in the space who are doing that today?
Well, right now, I'm not aware of anybody that's working purely through, but we're seeing a number of them emerge in places like companies like TradeShift and some of these other supply chain. They're really not in our business. They're in the business of facilitating the supply chain, but they're now seeing that there's an opportunity for them as they're approving payments that to also provide trade finance along with it.
Yeah, I was just going to chime in. So many investors right now in the Western world are chasing yield, and they're going farther and farther out on the risk spectrum to do so. And we're doing the opposite. We constantly ask ourselves, how can we reduce portfolio risk without sacrificing net return? So, and as we'll mention in tomorrow's short presentation at 11 a.m., our portfolio has actually been improving in quality on a quarterly basis over the past few quarters. So when we look at verticals and other markets, that's the first common objective we keep in mind, is we don't want to chase yield, we don't want to do subprime stuff, and we don't want to do anything where the yield's too low. Some of the student loans and some of those verticals, the yield's a little bit too low. We like high quality prime business loans as the next vertical we're exploring.
Yeah. Is that sequential improvement in performance, is that based on macro conditions? Is that based on underwriting? Is that is that kind of the originator identifying credit risks and removing them from the policy? What's driving that?
What's driving the
improvement, the quarter over quarter improvements?
That's us intentionally looking because of macro conditions. We're in a late stage recovery right now. When times are good, nobody thinks the party's going to end. But at some point, there's going to be another recession. There's going to be a down cycle. And so we look at our portfolio and our average weighted dollar default rate, which is currently at 5.96%. And a lot of credit analysts out there are saying, I've heard, to anticipate a 50% uptick in the next recession on prime consumer credit. And I never rely on what these guys say because they're usually wrong anyway. So, but we look at our portfolio and we say, okay, if we're currently at 6, and let's say we're netting 8.5 to investors going into the next recession, if the defaults increase by 50%, that's a 3% uptick. This means our net returns hypothetically fall to 5.5 in the recession, and then they rise again coming out. But I always like to double what everybody says, what the experts say. So everything we look at, we want to say, what if the default rates doubled? How does our portfolio look? And could it still be positive? So if you take a AA loan, for example, at Prosper, that grows to 6% with an estimated default of 1, 5% net return. If defaults double, then you have a 2% default rate, 5 minus 2, or 6 minus 2 is 4%. And so that's the way we're analyzing it. An HR might be 30% return with an 18% estimated default. That doubles to 36%, you're negative. And so that's the backdrop in which we put in our models and our filters with those types of risk models in mind.
In a very similar vein, at Blue Elephant, we're also concentrated on the higher quality assets. And one of our beliefs is that we're in a very benign credit environment. I mean, credit card default rates are under 1%. They're usually 4%. And we think that the real risk on the back end, the expected returns are very similar, kind of, so we're on Prosper in kind of your, C through E grades. And in a downturn, we think that the volatility or the spread that moves is going to be much higher than your higher quality assets. And this is still 3- and 5-year paper. We love the amortization. We love that it's still short duration. But 5 years from now, we could have a very different cycle. And so our answer to the question is, well, how do you then still generate returns that make sense? Is we put some leverage on the higher quality assets. But to be perfectly honest, we don't really buy anything below C on Prosper.
And what type of advance rates are you typically seeing on this asset right now? What's kind of the average weighted cost of capital that you're seeing for the senior debt?
Sure. I mean, from an advance rate perspective, our lender will let us go all the way to 3 to 1. Again, we don't think that's probably the prudent thing to do, again, in this environment. But the environment is still reasonable. So, we're very happy to run at kind of 1.5 to 2 times levered, again, on the higher quality assets. We think that's a comfortable place to be.
I think that's pretty interesting. With leverage coming into the market, I think it's hard to debate that this market became efficient quite quickly, maybe a bit too quickly. How are origination platforms keeping an edge, getting an edge when the market is adopting so quickly, and the markets are just becoming efficient before anybody really has the time to generate any alpha?
Well, I guess, to your point in efficiency, I think, sure, rates have come down for the platforms, but the volumes are there. They're increasing. And so I think you're still able to, with a combination of that and some leverage, able to generate a reasonable return. I mean, high yield is trading 4%, right? And that's, that suffered pretty bad during a kind of a 2008 downturn. I'd much rather own this stuff than high yield where it's trading today.
There is an interesting dynamic here. I started my first job was on Solomon's mortgage-backed securities desk in '94, so I got to get an idea of what securitization looked like, and then saw leverage in a lot of different markets. We're staying away from leverage. Any time in history that I've seen illiquid assets being levered, there's usually a bad scenario at some point in the future, and we don't really want to be there when the music stops. So we really haven't gone there yet. I am concerned any time these new illiquid markets start seeing leverage and derivatives and structured products on Wall Street. Just historically, if you look at the mortgage-backed securities, saving loan market, you name it. I think that the other thing you see, and everybody talks about this right now, is the sun is shining on this market as it is in Silicon Valley. Every originator is up 100, 200, 300% as far as assets coming in. And so I'm also interested in what this market's going to look like the first time we see a downturn, not just in defaults, but what happens when money starts coming out from investors? And how do platforms manage that? And I'm not sure I'm fully comfortable with that yet.
It shouldn't be. I mean, at Lending Club, when I would go into funds, we would say we've been around since 2007, and we managed a down cycle. But if you look at the vintage data and the volumes, then it was rather small, especially relative to where it is today. So that would be.
So I think one of the other things is institutions need to think about diversifying, not just by, where are we going? Right now we're in peer-to-peer. I think that in 5 years or whatever that time frame is, we'll be diversified amongst all of these different lending platforms so that we have diversity amongst these different, but also by time frame, right? I mean, I think that what you see is people come into this space, they like it, and all of a sudden 5% of the portfolio is in one of these things on day one. And investing in private equity or venture capital, these kind of illiquid spaces, you usually want to kind of tranche this over a number of years from a diversification and risk standard as well. And I think that's just something we're kind of starting to understand and evaluate.
John, you were mentioning about risk before, your earlier question. And something that we look at in our organization, we have a lot of experience in originating loans, servicing loans. And I think that you have to make sure, as what happened when the new Prosper management came in, that when you look at a new platform, that you have a remote vehicle if there's a bankruptcy, when the servicer, they have a backup servicer, so that as investors, that we're going to get our money back. So if there is a downturn, and let's say the platform goes out of business, I mean, this is a business and operational risk that you also have to look at, not just the loans and the defaults, that you have to look and see what's going to happen to my money and my investors' money if the platform goes out of business.
And given that, how are platforms handling retail investors' money? Because institutions are protected right now from a bankruptcy remote SPV, but retail investors are conditional liabilities, right? If the originator goes bankrupt, then they're an unsecured creditor to the originator. How are origination platforms dealing with that risk?
Well, I think that's why you have to look more towards the Lending Club and Prosper models, and a lot of the platforms that we've spoken to over the last day are hoping to get to the retail investor, but they're starting with the institutional investor because you have that remote vehicle.
No, that's a very good point. I think some pretty big news as of late was the news announcement from U.S. Bank, Union Bank, and Lending Club. I think very few people have really factored in the magnitude of kind of deposit-taking institutions, finance companies outsourcing their origination channels to online originators who can do it much more cost-effectively and much quicker. I think this is a first step in a massive transformation of a space. I just want to know your guys' thoughts. What areas outside of unsecured, why isn't this happening in auto finance or used motorcycles? Or, I mean, there's so many different ways that this can be applied. Why is it still just, a 3 or 5 year unsecured consumer loan?
I mean, secured paper is much more time-intensive, document-intensive than an unsecured loan, right? So an unsecured loan, either they pay or they don't pay. I mean, you can automate a lot of that underwriting. You're getting your ACH payments, et cetera. But if you have a secured loan, there's maybe UCC filings. You may have to eventually go into some kind of workout and actually have real recovery, right? So, and that process isn't a 30-day process. That's a 12 to 18-month process potentially. And so, the documentation and paperwork is non-trivial. And so, while we strongly believe technology is bringing down those costs, there's some of those that are still, in some ways legacy. I mean, a workout, lawyers will still take time to go through the docs. The court systems will take time to go through that process. And so, I think that you've started with the place where it's been the easiest to add technology, and then as that's been successful, you add it to new places, and I think that'll be the natural extension.
Yeah, I just want to add on it. In this space, in this sector, it's all about access. And so many institutions out there, I think, are missing the trade because they're just watching from the sidelines. They're doing their due diligence for the next 5 years. They're looking at, and so they're getting closed out. And it's hard to get on the platforms to go direct. So, you mentioned Union Bank. We're talking to another regional bank right now that's looking to allocate some of their funds to us and to other fund providers. And so I think that's what's going to happen is institutions out there that are doing their due diligence in the space, they know if you want to get exposure and you want to get access, you really have to partner with an existing fund to do it in any volume, and probably more than one fund.
And I think that's the route a lot of the platforms are taking right now, is to kind of allow the partners or the capital partners to create some type of franchise or equity value for themselves, and to risk the origination platform as well, from providing direct access to those investments.
But just think also from the mindset, put yourself in the chair of an originator. Would you rather go out and compete with a bank that's already got banks that already have a fixed menu of offering that they're well established at, or offer a product that's slightly differentiated that you perceive the market wants? If you look at what's the primary product that's driven this industry, it's a 36-month installment loan to consumers. What bank offers that? That's a solution. There's the other things that what's the other product that's primarily been working first in the small business side? A merchant cash advance. That's not a product banks offer. The next area that we're seeing a huge amount of volume and interest is in the segment of the population, the unbanked or the NFTF people who are not served by banks. That's where the volume is. So why beat them for an auto loan, which is something that's done relatively efficiency, when there's greenfield running in places where the banks aren't there?
Right. Speaking of merchant cash advance, one name I'm surprised hasn't come up is on deck, especially given the recent securitization news that was out this week. It's just pretty impressive, and congratulations to you guys for getting that done. Where do you guys think that space specifically is heading on a regulatory side? Given the perceived high APRs, where do you think that shakes out? And maybe you can highlight what are some of the current kind of controversial items in that area right now.
In the securitization?
In kind of the merchant cash advance.
Oh, and merchant cash advance. From our perspective, when we talk about all this stuff internally, from our perspective, we care more about what the collateralization is, if it's a secured loan, and more importantly, who's the person behind that loan. And so a lot of these merchant cash advances we've seen out there, a lot of them are subprime borrowers, and there's really little to no collateralization. So that's why that doesn't meet our guidelines for what we're looking to do. Regardless whether it's a business loan or a debt consolidation loan or a home improvement loan, we want high quality, short duration, prime credit. And so that's where it gets a little murky, the waters, is when you call it a category, merchant cash advance or small business loans, exactly what are you really investing in?
I think the thing that is stunning to us about that transaction is that merchant cash, the portfolio that was in there, doing this out of memory, roughly has an APR in the 40s, loss rates in the 7s, and was sold at CP plus 240, which is about 3%. So I think that's over collateralized by about 30%. So it's not the same thing as buying a loan at if you will, at par, straight up or flat. But that arbitrage is huge, and if you look at what On Deck done, which is very impressive, and also in contrast, is that spread they're capturing for themselves. Lending Club, by what we think of a Lending Club 36-month consumer loan is basically offered at par as probably worth 115 to 120, and Lending Club is giving that to the investor, if you will. Somewhere those two valuations have got to come together. And that is actually, from where we sit, probably one of the biggest threats to our strategies. Because if you look at where Noah is right now, he also runs a small marketplace. He can sell loans off at 3%, or he can sell them off at a marketplace at 10. What would you do?
I mean, for Blue Elephant, on the merchant cash advance side, we've taken the stance that the very high APR kind of credits, we're just not involved. I'm sure they all check out, but we've just seen too many times when regulators change their mind and you get that tap on the shoulder, and just no interest in getting that and having to explain why we meet the rules. To me, in the consumer side, we're buying things through credit card rates. That gives us some comfort. That's, no counsel will tell you that's a full check mark, but, common sense says, okay, you're probably playing fair from a regulator perspective. And the same thing on the small business side. I think, if you're through credit card rates, we feel comfort, our investors feel comfort that you're not going to have to go explain yourself that you've somehow not checked one of the boxes you were supposed to.
Now, Scott, you mentioned the non-banked or the unbanked before. How is an institutional investor looking at that market? What are they looking for from an investment standpoint? Is there anything out there from an investment standpoint?
I'm sorry, in which sector?
The unbanked or the non-banked?
Oh, the unbanked. Well, I think there's huge opportunity out there. You can't tell me there's 60 million people that are unbanked and another, depending on the numbers you look at, 15 to 25 million people where you can't get a full FICO score out of, that there aren't quality borrowers there. To serve that sector, because they're outside the FICO system, there's alternative credit methodologies that have been developed, which in our opinion are frankly more predictive than the FICO system as a whole. That borrower's only real funding alternative is a payday loan.
Right. And
there's a number of originators out there that are going after that market. They're using different credit methodologies or different servicing methodologies, and they're figuring out how to responsibly figure out what that customer can pay, and then charging them a reasonable rate for that and making money at it. Now that's a tremendous social good. It provides credit to a part of the economy that needs it, and from an investor standpoint, there's some real value there.
I think that market, the alternative financial services market, if you will, is $850 billion a year in transaction volumes, and $90 billion in fees and income. And can those I didn't think that payday loans could be extended to people without a bank account. Is that
exactly right? Yeah. No, the fundamental credit problem that originator faces is someone comes to them and says, I make this. Then, okay, prove to me that you actually do make it. And oftentimes, some of that can be done with data and other online technologies, but a lot of it still has to be done the old manual paper way. And the real issue is you're talking primarily about loans under $1,000. So you do have this small dollar cost loan. What we've seen in those models is what we call the bronze, silver, gold progression, which is your first-time customer, that's the bronze customer. Generally, you can't originate that loan, and even with pretty good credit performance, still make money on that loan. But if that borrower comes back, that silver borrower, if you will, can be very profitable. So the real question is, what's the ratio of the silver borrower to the bronze borrower? If it's a few percent, it's really going to be hard for that business model to work. But there's some really smart people doing some very interesting work in this area.
And given that Prosper and Lending Club both decline 90% of the applications, there's got to be some value to be extracted from those declines. How are you guys capitalizing on that right now? How are the originators currently trying to monetize those costs that they bear acquiring those declines?
So we don't look at what the originator declines. We look at what they approve, and then we look for others. If they don't want to make that loan, we look for others that want to make a comparable loan. Borrower expertise is what we're looking for. That's fundamentally what we're underwriting.
So you don't find that there's value in even a small, Lending Club, if they're doing $300 million a month and declining $3 billion a month, there's got to be some value that can be extracted, and
It is, but it needs to be extracted by somebody else. Is what I'm trying to say.
There's some platforms. There are some platforms out there that are looking at that, looking below the 640s, or looking at the people without FICO. And for our models that we developed in house, FICO is meaningless to us anyway.
Right.
So.
And
there's a fundamental break somewhere. I don't want to pick a FICO score, but there's a fundamental break where you go from a FICO score is about 1/3 based upon payment history, about 1/3 based upon credit that's made available, and 1/3 on other stuff like you've had liens or judgment against you. And FICO is proven to be fairly predictive of default on large pools of borrowers. Okay. Once you cannot generate a FICO score, then you're left with an alternative methodology. We call that capacity to pay. And as I said, we're pretty impressed with that. But different originators have different credit methodologies to take different approaches on different segments of those population. That's what we evaluate.
I think it's a great business opportunity for Prosper and Lending Club, and I think they're exploring. I think they're already in the works of monetizing that. And I echo the comments that with our existing fund, we're just not interested in those rejected borrowers. Maybe with other funds, possibly, but our attitude is why not leave good enough alone? And every decade over the centuries, greed, chasing a return, leads to painful and tearful lessons. And we're happy if we can do 7 to 9% net with very low risk. We'll take that all day.
If we were smarter than the originator, we'd be an originator, but we're not.
Eric, you're a guy who looks at kind of downside risks a fair amount for a big equity investor or somebody who likes to look at upside as well. What are the big risks to the model? What are you looking at? What's going to break the camel's back? Have there been any signs? What are your top 3 indicators of this could fail?
Yeah, that's a good question. So one, I see one of my big risks is I just see the growth of the business so quick, right? I mean, when we started doing diligence on Lending Club, I think it was 15 million in monthly originations. Took us about a year to get comfortable, and they were doing 50 million of originations. So how do you manage those businesses in light of the fact that now they're doing 300 million? I mean, just because when things turn, then you've got a lot on the books that you have to deal with. I think that's one. The other, I always get concerned when what you've seen and what we see in these markets is now people are showing clients and individual investors, institutional investors, these 5-year returns with absolutely no volatility. And so you kind of have an unrealistic expectation from some investors about the return versus the risk in those markets because no one's really showing anything through an economic downturn yet. So I think you have some people that might not be sophisticated enough buyers to understand really some of the underlying risks of that. And again, so that becomes, and again, I go back to what I told you before, which is any time that I have seen illiquid asset classes with leverage, and then you start to see flows change, things get ugly quickly. And so, I think that we're just in the early stages of this, but there's absolutely a marketplace that is in its first innings of this process. So I don't think that's something we have to think about. Again, see a recession tomorrow, but I guess I really think of it more as this is something as we grow. I see this fragmented market in the small business lending, and everybody talks about their risk management in issuing loans, but I look at it and say, if I'm in that market, I'm trying to get market share. And that is in total contrast to risk management as far as what I'm trying to do to build my business. And so I just see some things out there that, makes us cautious. We're gonna put a toehold in before we jump in head first.
I'd just like to add to that the only tool, to Eric's point, the only tool that we have for active portfolio management is duration. So if we start with a monolithic 36-month monthly installment loan on the consumer side or a comparable term business loan, you have your duration, including prepayments, maybe between 15 and 18 months. Okay, in general, you can see advance warnings of credit cycle deterioration 6 to 8 months in advance. You've got to have, if you're getting 3 to 4% of your capital back every month in repayment, that gives you maybe a quarter of your portfolio you can redeploy as you go into a stressful period of time. We've all got to get what we're collectively as a group missing is shorter term paper. Because we just don't, if we're all going into as Eric's describing, with what we think are solid portfolios into a stressful period of time, we just cannot reposition our portfolios fast enough to weather the storm.
One of the things that I'm a little nervous about being an equity holder of a company in the space is, are we a victim? Do we become a victim of our own success, right? Do we become too big, have too much of market share, have too many consumers' financial stability in our own hands where, government comes in and regulates the industry, where it kind of takes away all the equity value from the system as a whole. I don't know if that's something you guys worry about, and
That will likely happen if there's major problems. So if there's the next down cycle, a great recession or worse, and a lot of people are losing money, some of these leveraged funds maybe blow up, or people are focusing on high-risk stuff only, that's when government comes in and they over-regulate, and they pass draconian regulations to kind of screw things up for everybody. And so, and if that doesn't happen, our guess is they probably won't step in.
I'd add one more risk, which is everybody talked about how all their loan books, all the quality of their loans is rising. It's great. It's not because they're doing better underwriting, it's because everybody's credit is getting better, right? And so I think you start to think about these things, and everything looks better all the time, and we're getting more comfortable, and that can change on a dime.
yeah, one thing at Lending Club, we would never say that we underwrote better than anyone else, right? It's somewhat of a commodity, right? We just had a different subset that we would underwrite, a more defined subset. So, given that we have about 10 minutes left, I think we'll turn it over to some questions from the panel, or from the audience. If anybody has any questions for myself or the group.
My name is Heinz Blenneman. I'm with a single-family office, and this is a very interesting discussion. And I sort of see online lending as a subset of private credit. Private credit has been around for several years, and now online lending is coming into the picture. And I'd love to hear the views from the panelists on how they've sort of transitioned from being in private credit to online lending, and specifically on how they originate. So how did you used to originate private credit? Using brokers or originating directly? And do you now that there's online lending, do you use these platforms exclusively, or do you also originate the way you used to? Maybe kind of talking about how you have transitioned in origination.
Yeah. I'll have a quick excerpt on that. Is that as a salesperson on the sales side, I used to say that you can do everything cheaper, more efficiently through the online platform. You could give us your credit box, and we can essentially source those borrowers for you in a way that you never were able to do before. So, people who invested in private credit used us as a cheaper, more efficient way to get access to an asset that otherwise couldn't access. So, it pretty much gave them arms or reach that they never had really prior to that. But
Right. Yeah. No, I agree with what John was saying. Our funds are an outgrowth of our family office, and we would do these one-off private credit deals. And that's what makes this industry so great, is that it's not just a one-off. It's repeatable, it's scalable, and that's why we're in it.
Yeah, we sourced to some one-off private credit deals in the past as well, and that's what led to our investigation of peer-to-peer lending 3 years ago. Is a lot of these private credit instruments out there, we thought the intrinsic risk was much higher than the stated return. Some of these private REITs or debenture products, some of them are a little more risky than meets the eye. And with online lending, more efficient, it's easy to do, and so it was a no-brainer for us. Yeah.
And I'm sure the bankers who were bringing you those deals were taking it.
Oh yeah, and the other thing I wanted to mention on the transition from private credit, or is it more like a private credit market, it's a little bit more liquid than the private credit market, because there is a small secondary and growing market right now, and there's talks of having an institutional secondary market in the future where institutions can buy and sell loans from each other. So I think the liquidity is improving, and that will also make it a lot more attractive.
Yeah. Most of the major platforms right now have a pretty big backlog of capital, up to 2 to 3 years of visibility on their capital, grown at the growth rates that they're currently grown at. So I would say it's a quasi-liquid market right now.
Hi, I'm Jonathan Kramer from Zopa, and I wanted to ask the panel how, if at all, they were thinking about expanding lending through non-U.S. platforms.
We've looked at half a dozen. All of them have been in Europe. and they're, look, our industry started with you. You were before everybody else. The challenges we face in Europe really fall into a couple of layers. The first one is that in some jurisdictions, the borrower is used to a much lower interest rate than what's offered here, and so the returns on that just do not look attractive to us. And in particular, in some places, we see the originator is happy to match, to stay true, if you will, to peer-to-peer, that they can offer a low borrowing rate because their individual lender doesn't command a high rate, and that's where they want to stay. Having said that, there are, from our standpoint, the diversification of small business and consumer lenders in European countries would be an added diversification benefit for our portfolio. The other thing that we've learned a lot from Europe, in particular from Funding Circle, because chartered companies in the UK must report their financials to Company House, Funding Circle, we think, has the best small business model around. And they're trying to extend that here to the United States. So we learn a lot by looking in other jurisdictions where there's just a data advantage compared to the United States. A big challenge for us is withholding. So depending upon where you are, it doesn't do us any good to make a 10% return and have to click 200 basis points off of that and then make the LP have to file a return to get it back. That's just, for all practical purposes, a deal killer. Right. And then in some other jurisdictions, we have to provide the personal information about the LP to the local taxing authority, and we're not going to ask somebody to do that.
I mean, and just to add to that, a big risk is also currency risk. I mean, if let's say you get net 12%, but the currency moved against you 20%, on something that should earn you a nice return, you're now down. So that's something that we're looking into to see how we can hedge that out or work our way around it.
Yes, go ahead.
I wanted to get your thoughts on the possibility of a U.S. listed product in the near future. I know Liberum just listed a closed-end fund on the LSE, I believe within the last month or two. I was wondering when you might foresee a mutual fund, listed closed-end fund, or business development company that focuses on P2P loans.
I think you'll see that sooner than later. I think that's a great value proposition for anybody who's doing that. If you look at kind of a closed-end vehicle, compared to, let's say, a publicly traded BDC that's a private equity arm, with a BDC that's a private equity firm, you're taking dealer risk, market risk. It's essentially a blank check company. For a closed-end fund that's publicly traded, that's buying collateral that has consistency, you have full visibility on the assets that you're buying, you have a track record of the assets, the premium to book that would trade at, I think, relative to any other closed-end fund would be quite substantial. So, I think that is a way a lot of investors can really, for some of the new origination platforms that are looking, it provides also a permanent capital vehicle for the origination platform, right? They don't have to worry about redemptions or any of that variability. So, I think you'll see when maybe the next, 6 to 18 months. But I think, once one is done, you'll see, several others follow suit because it's a very lucrative opportunity for the person who's doing the closed-end vehicle, and it's also a great product for retail investors to have, something that has daily liquidity. Anything to add? Well said.
Well done.
Yes.
Hi. One of the concerns I'm hearing from the panel is the risk of bearing unsecured or unhedged credit risk through the business cycle. And the response to that has been to focus on shorter durations. Do you think there's institutional appetite or demand for hedges, much like what you see in the corporate credit or corporate loan or muni bond market, that might be applicable to the peer-to-peer market?
I think there's applicability. I think there's concern once we get into sort of any credit default swaps or anything that might be kind of hedging that out. You see what happens in these markets once those kind of things take over. So there is applicability, and certainly, I think as this market continues to mature, I think the market needs to be mindful of that because you can see what can happen with the risk that gets accelerated in these markets if those kind of structures become available. But I think that it's probably inevitable.
Yeah.
And to that point, I think the real concern around that is, if a derivative market ever came to be, is what would its size be relative to the actual cash market? And I think the problems we saw in kind of the financial space was that those markets got so big, they were actually pushing the cash around, when in fact that was just re-hedging or something on a bigger book size. So while there's I think theoretical value in being able to hedge some of that, I think a simpler way would be to have a secondary market where you actually just sell the cash.
It's somewhat counterintuitive to the model, right? Of simplicity and transparency is what's going to drive this, right? And that kind of that takes away from all that. We have time for one more question that we'll take, and then we have to wrap this up.
Can I just go back to what his question was?
Sure.
I think that it's necessary as this industry becomes more institutional quality. That's a question that we're asked all the time from potential bigger investors: is how do you hedge? And it's not just selling it in the secondary market, which we think is going to be fantastic if and when there is a secondary market. But I think that there is a way to have securitizations and to have also a hedging secondary market where you allay the risk, you move the risk around.
Well, I think we'll wrap up there. Well, thanks everybody for your time. I really appreciate you sticking with us so late in the day. And I think we have a follow-up session now. So.